Herzlich willkommen bei der Edelstoff Media. Ich spreche heute mit Pilar Gomez-Bravo. Sie ist Co-CIO der Fixed-Income-Sparte von MFS. Miss Gomez-Bravo, let's start with the dreaded R word. Is the recession still coming, or have Europe and the United States come through the crisis more robust than everybody expected?
I don't think there's a free lunch. So I find it difficult to believe that having hiked 500 basis points so dramatically with the inflation issues that we had, that there is no pain to be had. So if you think about the potential outcomes, the tail risks are still for higher risks of recession than otherwise. So it all depends, frankly, on what the central banks do. If the central banks were to be early and start cutting, they're already a bit late, then maybe you could get that, that miraculous soft landing. Unfortunately, central banks tend to be lagging, and therefore, all else being equal, base case could be a slowdown in growth, while this inflation comes down. But the reality is that we're probably, all else being equal, probably think that there's more likelihood of a hard recession than a no landing where, everything is great.
So how do you organize your bond portfolio in view of this outlook? Where do you see opportunities? Where are challenges?
I think that the more diversification that you have, the better in uncertain times, right? So if you do have different levers that you can pull, if you can find more flexibility as to how you can invest within whatever mandate you have, then that's probably a good thing to do right now. I think that having a combination of risks in your portfolio, where let's say at least 2 out of 3 are working, is probably a very good thing. If we believe that whether you are in a soft landing, so slower growth, disinflation, or a hard landing, rates are likely to come down, yields are likely to come down. So this year, we would think having duration in your portfolios is going to help. On the risky asset side, it gets a little bit more difficult. It really have to be selective. I think this year is going to be great for active management because you're going to have winners and losers. And if you have a good research platform that can help you identify the opportunities, but also protect the capital from the downside, then I think that's going to be very valuable in the next year to 2 years, where again, I think that you're going to have more dispersion, more volatility. You will have risk-on periods and risk-off periods that are going to challenge investors. And so being nimble, having strong research, and having diversification would help. So long duration, relatively defensive credit risk, and sort of look for things that might give you a lot of convex payouts. And by that I mean that you have more upside than downside, which is difficult in fixed income because by definition, we don't have a lot of upside.
So how is your team managing the active fixed income strategy given the uncertainty in central bank policy in Europe, United States, and so on?
So I think we have a very strong bottoms-up lens in sort of the credit exposure that we have. So a lot of the decisions that we're making especially in the credit portfolios, the Euro Corporate Bond Fund, et cetera, is really driven by the strength of our analyst conviction. So we have a team of analysts and they rank their recommendations as a 1 buy, 2 hold, and 3 sell. And so, for example, the Euro Corporate Bond Fund has 71% of 1 buy rated names. So that is kind of the starting point. The first lens is to make sure that we own the credits that we like, that are resilient in the different scenarios that we want to stress. And then on top of that, again, you decide kind of what hedges you can have in place in case, again, you go into the tail risks. So, I think duration can help in that context. And in general, we have portfolios that are diversified in rates. What we think is that if you can, being able to have exposure in different rates markets is also helpful. But in particular in the credit markets, I think you can have some barbells, pick some good high yield stories that are going to get upgraded or are short duration, and really have the essence of the rest of the portfolio in areas that are attractively priced but more defensive. And so, for example, one of the things that stands out in credit markets is that financials across the world relatively are pretty cheap still. So we tend to focus on things like that.
There are a lot of elections this year. I think the most important one in November. I think you know what I talk about. And these elections will shape the world. You said diversification is still your best friend in uncertain times. Can you explain why?
I mean, I think when there's uncertainty, you need to get paid a higher risk premium. So all else being equal, you demand higher risk premium. And when the tails are fat, when you have a higher chance that something goes wrong or that you've missed something, then being able to identify different pockets of risk that you have in your portfolio will help mitigate the volatility. So uncertainty tends to equal volatility. Active managers, by the way, should thrive with volatile and dispersed markets because that's when you take risk. So we're actually very happy as active managers that we are in periods of volatility and dispersion because it helps us deliver the alpha for our clients. But all else equal, diversification provides a mitigation to volatility, and therefore your risk-adjusted returns should be higher until you can find more conviction to take more directional bets in the markets. And so for now, I think that we continue to favor that. I think one of the very important things when you're investing in credit is that you have to be early, not to be late. Because it's in a liquid market, it's an over-the-counter market. And so what that means effectively is that as a credit manager, you always feel like you're leaving money on the table, either because you're reducing risk too early and selling like high yield, like we've done to some extent, or because you're jumping in when it's scary to jump in, when spreads are really, really wide. So I think having a bit of a contrarian approach and a diversified approach helps the portfolios that have credit risk in particular be more resilient.
The MFS Euro Credit Fund will be 5 years old in February, so congratulations. So you have fully experienced the interest rate turnaround. So is it, you talked about alpha, is it easier or harder to generate alpha now compared to the management in 2019, for example?
So it's, I was thinking, looking back now that, you're celebrating 5 years, we're celebrating 100 years and 5 years for the Euro Corporate Bond Fund. But the 5 years for the Corporate Bond Fund, what an amazing, difficult 5 years, right? I mean, you had the COVID crisis, then you have the inflationary spike, then you have the correlation
there was a lot going on,
of equities and fixed income driving total return significantly down. So we've lived through a lot in the last 5 years. I think ultimately, now, like it was then, and again, I actually, for better and for worse, was managing portfolios at Lehman Brothers. Asset management Lehman went under. So that was even more difficult. But going forward, I think ultimately you need to sort of extract the noise from the signal. You need to sort of continue to deliver consistency of process. And so what, again, we try to do is be very deliberate around the credit risk. Right now, I think because of the difficult environment that we're going to have, I think the challenges are still the same. You want to find uncorrelated risks that deliver consistent alpha, right? And so portfolio construction becomes more important. The technicals that dominated the market, and by that I mean central banks buying all these bonds, are no longer there. And therefore, we hope that in the next 5 years, you're going to have more risk that is aligned with the capital allocation decisions that all investors have to make. And therefore, it would provide a lot more opportunities for active investors, active managers, to take risk without having to worry about no yields and no spreads because central banks are buying everything out there.
So let's talk about high yield. The Fed is talking about higher for longer. Maybe it's a little bit longer this year. So is there a risk of increased bankruptcies in the high yield segment? And if so, how do you deal with that in the Euro Credit Fund?
There is higher risk. I mean, when you're going down at the end of the cycle, you tend to have defaults that go higher. They probably may not go as high as other periods because in general, high yield companies were able to refinance a lot of their debt back in 2021. And because some of these high yield companies have become more resilient in kind of how they manage the cash flows. But nevertheless, it's, when I think about a recession, you asked me about, recession, the R word. I think about a recession meaning two things. Unemployment goes up significantly and defaults go up significantly. Because if those two things don't happen, even if you have a technical recession, like maybe in Germany, for us as investors, it doesn't really matter. When you feel it is because defaults, you're going through the credit cycle. So for the Euro Corporate Bond Fund in particular, going into that cycle, you obviously manage your overall high yield allocation. You maybe cut shorter duration. So you sort of try to focus on shorter pieces of paper that are going to mature, where your analysts can measure the cash flows to pay you back. You buy more resilient businesses that are less cyclical, or you avoid, the very highly levered businesses. What I think is clear this time around, which goes back to the defaults, is that there are certain businesses that cannot operate with rates where they are. There are businesses that have enjoyed leverage that was free. And at the point that they have to refinance is when the pain hits. So a lot of times they say, well, no, we've managed to, again, have a free lunch. It's because the lags of higher rates have not hit companies' earnings yet. The moment that a household has to borrow again, or a remortgage, or a corporate has to issue. If you're in high yield and you have to move from your coupon that was 3% to now having to pay 10%, there are companies that are not going to be able to survive. So for us, it all comes with the analyst making sure that the cash flows are there to pay you back.
So what's the most important factor in the high yield segment you're looking on?
So we're looking to resilience in the balance sheets, where you can sort of see a commitment and a willingness for managements to continue to deliver the balance sheets. We're looking for visibility around cash flow generation. So make sure that certain companies that have contractual revenues that are easier to track are going to be more resilient. And the other thing that we look for a lot is collateral. Right? You want assets to back you up. And so what that means is that traditionally companies that have fixed assets, you're going to prefer to, the media companies that don't, right? Or software companies or tech companies or things that don't have hard assets because they've already sold them. So those things, you want to have the collateral to back your loans or your bonds in high yield. You want to identify companies with resilient cash flow and visibility of the cash flow. And you want to find companies that not only have the capacity, but also the willingness to deliver and don't have a lot of goodwill on the balance sheet. All these acquisitions that were made at very high multiples that might have to be written off.
What do you think about emerging market bonds? Are they just a nice add-on in your portfolio, or are they an underrated asset class?
I think it's a little bit of both. It depends. EM corporates are interesting because you can find very good ideas. And again, you're always looking for diversification. So you might find a very good EM corporate that provides something different than buying yet another auto company or something like that. So we do like to have some EM corporate exposures idiosyncratically when we can find them. But whenever, again, you're investing in EM corporates or in some high yield companies, liquidity is key. So our Euro corporate bond fund is going to be, one of the objectives is to provide a liquid exposure to credit markets. So when you're buying EM corporates, there can be a structural allocation to EM corporates for some investors, but you have to understand that the liquidity is not there so much. So you can't just buy and sell easily as an asset manager. Obviously, if you're an investor in a fund, that's daily liquidity, you can. But as an asset owner, an asset manager is going to be more difficult. So I think what you can do with EM corporates, to some extent with high yield, if you have the flexibility, is set your strategic allocation, whatever that may be, and then move around it. Don't always stay, don't make it a structural allocation. It is underrated, EM, but you don't always have to be 10% EM, right? So I would sort of say set whatever percentage feels right for the risk that you want to take. And then it's a cyclical market. It's very correlated with equities. So if you look at high yield and emerging markets, the long-term correlations with equity markets are pretty high. You have drawdown risk in EM. So you just have to be more nimble. So between the diversification and being nimble around the asset class, I think that can sort of give you pretty good alpha that also complements the other alpha sources that you have in your portfolio.
And another anniversary, I think it's the first time I have two anniversaries in one interview. MFS is going on 100 years old this year. So congratulations again. Most people associate your company with equities, but you were also one of the bond pioneers in the 70s. What lessons from the past are still relevant today for the successful management of bond portfolios?
Yeah, actually, people maybe not realize that we launched our first US corporate bond fund in the 70s. One of the funds that I manage is a global opportunistic bond fund that was launched in 1989. We launched our emerging market fund in 1997, but we are obviously much larger in equities than we are in fixed income. I think the lessons learned are still the same applicable, fundamental, simple value proposition. You need to do your homework, right? As an active manager. And that means really understanding the credit risk that you're underwriting or any risk that you're underwriting. And that's going to help you a lot. So you need to understand the fundamentals.
100 years of homework sounds
exactly.
fun.
100 years of homework and another 100 more to look forward to. So do your homework, do it independently, do it collaboratively. So I like to think about, the kind of the 3 C's that help you out, right? You need to, our essence is collaboration. And we do believe strongly in collaborating with equities as investors or other parts of the firm. That will give you 2 + 2 = 5. That will give you more alpha. So that continues to be at the core of managing fixed income, which has a lot of asset classes in it, right? The second one is be consistent, right? So be collaborative, be consistent, not consistent only because you want to deliver consistent alpha through the ups and downs and cycles of fixed income, but because you want to have a consistent process. And finally, in fixed income, again, where you have no upside and you have a lot of downside, have conviction. So make sure that the risk that you're taking is smart risk. We get paid to take risk. So make sure that as an active manager, you can deliver security selection, which is the global research platform, the collective wisdom of your research, your fundamental approach, your homework, but do it in a very tightly risk-managed package, because in fixed income, there's a lot of moving pieces. And so if you have portfolio construction and risk management with the wealth of the security selection, in 100 years, you'll still be able to generate good risk-adjusted returns in the asset class by having this nimble approach that is based on conviction, consistency of process, and collaboration.
So, thank you for the interesting insights. Vielen Dank fürs Zuschauen, meine Damen und Herren, und bis bald.